This tutorial is the first one of a 4-part series where I will show you how to sell options for income and, more importantly, how to manage risk. We will progress from easy to intermediate to hard mode until I introduce to you the overall quantitative framework that I am using to make it all happen. Today, we're going to start easy with a real-life trade example, and I will show you how I managed to pull a profit from betting on the upside of a stock that violently swung within a range of 38% in the worst possible market phase in the third quarter of 2023. So if you're ready, I'm ready. I want to start by saying that most traders who attempt to demonstrate their theory will almost always do so by taking advantage of a favorable market environment. That is the misleading power of anecdotal evidence, and most people fall for it. In my opinion, this is highly disingenuous because you can only show the power of a method when the context is not favorable. So let's switch the plot for once. In this tutorial, I will be using the context of a pretty brutal sell-off that unfolded in late 2023, where the S&P 500 fell by as much as minus 10.9% in just 3 months as the Fed was raising rates. I believe that this rugged market environment provides a credible sandbox to demonstrate the power of the quantitative framework that I will be showing you. Now note that this trading system is the exact same system that I have been using for years as a bank trader and portfolio manager during my years in the industry. It is a 5-step process that covers both the timing of trade entries and a multifaceted contingency plan for managing position risk throughout the life cycle of the trade. In this first example, as I promised, we will start easy. We will look at a real money trade that I took on Tesla options during this exact broad market sell-off that I'm talking about. A put option with a strike of $185 and a maturity of November 17th was sold on August the 17th for $7.25 when Tesla traded around $225. This trade allowed me to collect $725 over 92 days while putting $18,500 as collateral. That is a flat yield of 3.9% or 16.4% annualized. The first observation to make here is about the timing. As you can see, shortly thereafter, the stock rebounded sharply. Now let's pause for a second. I want you to note that the option position is as simple as it gets. It's not a calendar spread, it's not an iron condor, it's not a strangle either. It's just a puny little cash secured put. And this is the first thing that I want you to take away here. The power of the option trade itself does not lie in the sophistication of the option combination used to implement it. Rather, it lies in the accuracy of how the volatility of the underlying stock has been modeled, despite how the options market itself is valuing it. And here, the immediate rebound in the underlying stock shows that the volatility quantification was accurate. So let's focus now on the entry portion of the trade and the sequence of steps that prompted me to initiate that position at that moment, at this specific strike, and at this precise maturity. To start with, the first step of the quantitative framework consists in pitting two measures of volatility against one another. Number 1, I pick a certain average of implied volatility as priced in directly by the listed options market. As you will find out by using the system, most automated market makers on the options market use very naive statistical models to assess true volatility and end up mispricing their contracts as a result. This is precisely what we will exploit for profit for a good part. Now, number 2, I use the average implied volatility that I just calculated and I compare it to my own proprietary quantification of expected vol by drawing it from a realistic assessment of true historical vol. That quantification gives me a downside threshold for the stock that will need to be triggered before I even consider a trade. As it turns out, with Tesla opening at $226 on August the 17th, that trigger was met. Step 2. Now that average implied volatility has been dealt with and I know at what stock price trigger to initiate my trade, it is time to look at the bigger picture and make sure that most of the residual tail risk has been taken away from the trade by the market. In order to achieve that, I look at extreme vol and assess the realized fat tails of our probabilistic distribution. This gauge here on the model is giving me a quick look into how stretched the current move actually is versus 2 calendar metrics of volatility nuanced into 2 statistical quartiles. That's 4 criteria. And once again, as it turns out, the setup on Tesla as of August the 17th passed all 4 criteria. Moving on to step 3. Now that both average and extreme volatility have been taken care of and we know that Tesla is ripe for a cash secured put, it is time to fine-tune the short-term timing of our entry in order to maximize every last bit of premium that can be extracted from the market. To achieve that, we use a time-tested yet very simple indicator in order to identify the short-term oversold condition of the stock. And it so happens that this very condition was also met during the session of August the 17th. So to recap, so far we know that Tesla is ripe for a cash secured put. We know that most of the tail risk has been exhausted and priced in. And we know that the current stock move is maximizing the premium that we can collect in the short term. So since we have quantified the baseline strike that we should shoot for using our volatility model, it is time to focus on contextually adjusting that target strike. In order to achieve that, step 4 consists in extrapolating the strike adjustment by identifying the significant or open interest bottlenecks or OIBs that formed in the recent past. And I mean on the stock, not the option contract. To identify those, we have two options. For those of us who benefit from a Bloomberg subscription, we simply apply a specific indicator designed to do just that. These horizontal lines here on the screen indicate the price levels at which the heaviest volumes were recently traded. The longest lines are what we would go for as a baseline. In the case of Tesla, that lower level was automatically identified as just under $200. Then, that level was further refined by scrubbing the chart manually. This additional manual process alone is what you would be exclusively doing in case you do not have access to a Bloomberg terminal. To do so, we whip out a crosshairs tool and use a method described in the framework. As it turns out, that optimal level ended up being exactly $185, and this is where the strike was chosen for the trade. Step number 5 is very straightforward. We seek to extract a premium that meets our minimum flat and annualized yield criteria, while keeping the maturity as short as possible to maximize the negative impact of theta decay on the options price. For the newbies out there, theta decay is convex, meaning that the closer we are to the options maturity, the faster the options price will drop, everything else being equal. And that's what we want since we are shorting the put contract. In the end, the put contract that matched those minimum criteria described in the framework at a strike of $185 fell on the November 17th maturity date. And I managed to generate a flat yield of 3.9% over 92 days, or 16.4% annualized. Now, let's take a look at how the trade unfolded. As I pointed it in the beginning, the stock dipped a little more from there, but massively rebounded by as much as plus 24% from our entry point. Obviously, the put value got wrecked, which is what we want. Still, from mid-October onwards, the stock collapsed again to just below $200 before stabilizing just shy of our strike of $185, which allowed the option to expire out of the money on expiry day. As you can see, the strike of $185 played the role of heavy support, which was the expected outcome by both the model's volatility analysis and the second layer of adjustment added by our analysis of outstanding open interest. So what are the 3 takeaways from this trade? First of all, it was a simple trade. The bulk of the risk was managed way ahead of time as we cut the volatility risk short before it got realized. We'll see more complex examples of how risk should be managed during more dire situations in the upcoming tutorials that will take the difficulty up a notch. Second, the framework helped identify the trade entry points that coincided with short-term peak fear with a very high degree of precision. That alone facilitated managing risk during the life cycle of the trade. Had the entry not been so accurate, we would have been exposed to deeper drawdowns in the stock and most possibly below the strike. And third, the quantitative framework models volatility in such a way that it pinpoints when the correlation of the stock's volatility gets dislocated from the markets. In other words, the system identifies the point past which there is so much pent-up fear in the stock that it can now have a behavior of its own without the market creating any further correlative drag on it. In the case of our trade, between the entry point and the first opportunity that we had to exit at a profit of 75% or more, which was between the entry of August the 17th and the put options maturity, the S&P 500 rose by as much as plus 2.5% and dropped by as much as minus 6.9%, while Tesla rebounded by as much as plus 24% and dropped by as much as minus 13.7%. That is a reward to risk ratio of 0.36 for the S&P 500 versus a ratio of 1.75 for Tesla, not even on the same planet. Yet, it was achieved during the exact same market phase, so I think that this asymmetry here definitely speaks for itself. So that closes it for our first real-life example. This one was on easy mode, but lucky for us, the market offered pretty challenging times in the second semester of 2023, and we're gradually going to take complexity up by a few steps in the next episodes. We'll be looking at how to cut risk early on another live trade that I took during the same period, so strap in for the next one. If you like this content, please don't forget to support this small trading channel by liking and subscribing. It helps me a ton to push genuine trading education that does not rely on the usual trap of drawing on charts and reading candlestick patterns. So stay tuned for more quant goodness, and I'll talk to you in the next one.